Capex growth for AI infra has been very high recently. TCS said annualized AI services revenue was roughly about $1.8 billion. Tech Mahindra now gets about half of its revenue from these very fixed price and outcome based deals. How fast can India and the Indian companies integrate AI? In 2025, AI adoption in India shifted from experiments to actual routine use. Most AI budgets for many companies were initially towards infrastructure such as data centers, computation power, and foundational tooling. We covered about data centers in one of our previous videos, you can check that out as well. But the next stage is where it gets interesting. This is where we are going to see incremental gains coming from actually investing in hardware and actually seeing the attention shift towards software, platforms, and how we can modernize a lot of these AI programs. So the earlier technology cycles that we have seen historically saw a lot of heavy capex investment first, and then the following subsequent years were followed by a focus on services. Capex growth for AI infra has been very high recently, upwards of nearly 50% and 65% in the last 2 years. So there are a few important questions to ask here. The first one is, what trends are we seeing from the latest IT earnings reports with respect to AI for the Indian market? Second is, will the AI cycle follow a similar pattern to cloud infrastructure with a transition towards services for AI as well? And finally, how fast can India and the Indian companies integrate AI, and where does it actually change outcomes for these companies and the economy? So let's get into it. Indian IT's quarterly earnings are less about one quarter's profit and more about whether the services model that we've been following for so many years and so many decades is holding up under three key pressures right now. The first is tighter global discretionary spend for many corporates. Second is there's a lot of client uncertainty, specifically in the US. And finally, the third point, the most important one here, is the rapid AI adoption that we're now seeing across many companies and many enterprises in terms of how the work is getting done and how that is being priced. This earnings season, multiple companies took one-time hits linked to India's new labor codes, and that can distort how you look at the profit picture. So it's better to actually read the underlying operating performance accounting for these adjustments. Infosys and HCL explicitly have called out the labor code linked adjustments in their disclosures, and media coverage from TCS has also tied part of the profit dip that they've seen to these costs. The big takeaway here from the Indian IT quarterly earnings reports is that the large cap Indian IT players are trying to shift from a very pilot heavy AI conversations model to actually be doing deployable AI work, while also pushing the productivity hard enough that the headcount is no longer necessarily moving in line or correlated to the revenue that they're generating. So let's quickly look at 3 or 4 of the bigger players' quarterly earnings reports. TCS has reported a revenue of around 67,000 crores in quarter 3 of FY26. This is about nearly 5% year-on-year growth, while the net profit fell by about 14% to 10,000 crores. And widely, a lot of this has been linked to those one-time items that we spoke about in terms of restructuring, legal costs, labor code changes, etc. The operating margin has stayed steady at about 25%, which is what we are concerned with right now. And this matters because it signals that the company is able to defend its profitability even when the quarter has been seasonally a weak quarter. When we look at Infosys, they reported about 45,000 crores in terms of revenue. That's about 9% year-on-year growth, and also has seen strong deal traction with about $4.8 billion in large deal values, commercial values. Infosys has also seen its headcount grow by about 5,000 odd employees. Forward expectations for Infosys show FY26 revenue growth guidance about 3 to 3.5%, implying that they have still got strong pipeline conversions and are more confident than they've been in the previous quarters. HCL reported about 33,000 crores in terms of revenue. It is grew by about 13.3% year-on-year and about 6% on a quarter-on-quarter basis. When you look at the graphs, what you see is that the operating margin was roughly around 18.6%, which means it's recovered over the last 2-3 quarters and is sort of hovering back in the range of what we were seeing about a year back. Now, Tech Mahindra, another large player, reported earnings and revenue of about 14,300 crores, which is again up about 8.3% on a year-on-year basis. In terms of the profits, it was about 1,100 crores, where they saw about 14% year-on-year growth. They also saw margin expansion and market coverage improve, and ultimately what we are seeing is a multi-quarter improvement trend here as well. So what was interesting this quarter was that we started seeing AI come up more concretely in a lot of the disclosures from these large cap IT players. TCS said annualized AI services revenue was roughly about $1.8 billion, and its own press releases spoke about this being a very fast growing stream within its broader services business. When you look at HCL, it again reported advanced AI revenue about $146 million, which is up about 19 to 20% on a quarter-on-quarter basis, and also stated that the bookings and the revenue momentum that they are seeing has helped push overall revenues, annualized revenues, upwards of 15 billion. Infosys also emphasized enterprise AI through their Infosys Topaz and positioned that as part of what is driving the performance, the client perception that they're seeing, which is how a lot of these firms are trying to defend their relevance as AI adoption accelerates. So AI services, however, are still a meaningful part of the overall revenue, but it's still a very small single digit share as of now in terms of annual revenues. The harder question here for a lot of these players is how do you monetize AI services and what is the right price point for a lot of these services. Indian IT is responding to a lot of these pricing and monetization challenges by pushing a fixed price and outcome-based construct or revenue contracts. Tech Mahindra, for instance, now gets about half of its revenue from these very fixed price and outcome-based deals. So that is what we're going to keep a keen eye on in the next coming quarters, which is whether a lot of these outcome-based deals are going to improve the margin substantially, or is it just a way of shifting the risk onto the vendor when markets are a little volatile in terms of demand cycles. So what we're seeing with AI is obviously new, but we have been through many tech cycles before, and Indian IT has also seen this before. During the early cloud infrastructure that was being built out in 2016 to 2018, we saw cloud migration and a lot of consolidation happen between a lot of the displacement in terms of traditional service lines and a lot of pressure coming in from a pricing perspective. But once infrastructure had stabilized, there were new revenue opportunities that were emerging, which outweighed the initial revenue loss. The key here is that these are new categories and they were not nice to have. They became prerequisites for using cloud at scale. Indian IT historically scales well when the market shifts from buying technology components to buying transformation programs. AI deployment is likely to have, from a behavior perspective, multi-modernization wave, which ultimately could help support a longer services runway for a lot of these Indian IT companies. As US uncertainty sort of persists, Europe has become a brighter spot for many of these Indian IT firms. And this geographic shift that we're seeing isn't necessarily just defensive, it's also where a lot of the incremental growth is coming for many of these companies. European growth for Infosys and Tech Mahindra was stronger than what they saw in the US. There were faster growths in markets beyond the US as well, and beyond Europe. We saw growth in Japan, Southeast Asia, Australia, specifically for Tech Mahindra, and other regions for HCL Tech as well. Now, these geographical areas are becoming a meaningful swing factor when the North America IT services boom has sort of paused over the last couple of quarters. What we're also seeing is sovereign AI, cloud, and sovereign AI infrastructure becoming a recurring client need now. Largely, this is being driven by governments and firms wanting less dependence on US-focused hyperscalers and US corporates. And if this continues to grow, IT firms could see strong revenue pipelines due to larger multi-year programs that could look more like platform-led, major transformation work. And this is something that the Indian IT companies have historically been doing well and better than what you can see from a short-term cycles where you see discretionary projects coming in and out. Indian IT's path to winning in AI is not to outspend these large hyperscalers or AI model labs or build major AI infrastructure. It is actually to own maybe the deployment layer as of now, turning this enterprise AI from pilots into maybe more production through modernization, data readiness, integration, governance, AI operations, etc., etc. The demand cycle is transitioning from a lot of the infrastructure spend towards the services spend, with meaningful impact building potentially coming in FY27 and in FY28, which supports a scenario where IT services growth is going to accelerate as AI moves into more and more major deployment for more and more corporates. But this win is going to have to be earned. We will see AI compress a lot of the low-end work, and the contract models, pricing models may shift towards outcome-based services. IT firms that can do these three things maybe are ones that we need to look at. One is those that can move up the stack in terms of AI modernization and platform-led delivery. Another is aligning strongly with many of these hyperscalers while staying valuable in terms of the integration and the actual governance layer that is needed for AI. And finally, how can you protect your margins by industrializing delivery, packaging the delivery capabilities that are needed for IT in terms of more reusable software-like assets. So we hope you enjoyed today's video. Do like, share, and subscribe. Let us know in the comments what other topics you want us to cover next. See you in the next video, and happy investing.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.